Hello guys and welcome to the YouTube channel. In this video we are talking about Warren Buffett, how to achieve 30% return per year, 7 investing rules. Before we continue our video, make sure to subscribe to our channel and hit the bell icon for more videos. So let's get started. When Warren Buffett was just 25 years old, he started his first investing firm, Buffett Partnership. This investing firm existed from 1957 to 1969, and in its time, Buffett achieved an average return of 29.5%. The interesting thing about the way Warren Buffett invests is that he uses very simple methods when it comes to investing to achieve these high returns. As Buffett says, you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with a 130 IQ. Rationality is essential. So, the key to achieving high returns is being rational and following simple strategies and sticking to them when times get tough. Now, what I want to do is teach you the 7 investing rules that Buffett used to achieve such a high return. But, I'm not saying that you're gonna achieve a return as high as Buffett's. I mean, he has dedicated his life to investing, and he's a very wise man. Nevertheless, if you can follow these 7 investing rules from Warren Buffett, it will drastically help your overall long-term return. Step number 1, if the business does well, the stock usually follows. Warren Buffett learned this rule when he first picked up one of the greatest investing books of all time, The Intelligent Investor by Benjamin Graham, who later became Buffett's mentor. One of the rules taught in the book was very simple. The rule convinced Buffett that when you own a stock, you own a piece of business, and over the long term, if their business does well, the stock will also do well. So, look for the companies that are going to dominate in the future, that make a high profit margin, that is ahead of the competition, and one their consumers love. You don't need to complicate it. Stocks are a part of the business, and if their business does well, you will do well. Step number 2, most news is noise, not news. This may be considered an unpopular opinion from Buffett, but most news that you consume is not necessary when it comes to investing. You see, the thing is, news programs like CNBC, news websites, financial YouTubers, they're all paid to get as many views as possible. So what they do, they create as much hype or tension as they possibly can to get those views, so that they can get paid more. You only need to pay attention to about 5% of that news. As Buffett says, owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners to cause them to behave irrationally as well. Because there is so much chatter about markets, the economy, interest rates, price behavior of stocks, etc., some investors believe it is important to listen to pundits, and worse yet, important to consider acting upon their comments. Don't worry about the pundits and don't worry about most of the news. Just pay attention to the key and important details. Step number 3, when you buy a stock, plan to hold it forever. Now, I hope this is a financial principle that you have been taught before, that compound interest is powerful. When you get dividends or capital gains, and you let that compound on itself and grow like a snowball, you can make a lot of money. But, if you're constantly buying and selling stocks, you're not letting compound interest do its thing, and you will miss out on a lot of returns. That's why they say it's all about time in the markets, not timing in the market. So, the key to investing is when you buy a stock, you should plan on owning better quality business forever. That's why Buffett has owned stocks like Coca-Cola, Wells Fargo, and American Express for over 25 years. As the great Philip Arthur Fisher says, if the job has been correctly done when a common stock is purchased, the time to sell is almost never. Step number 4, only listen to those who you trust and know. The great thing about investing is that we're not in this alone. Even Warren Buffett, throughout his investing career, has always been learning and listening to other investors. When he was younger, he had the investing mentor Benjamin Graham, who taught him the ropes of investing. When he got a bit older, he always had Charlie Munger at his side to see if he had the right opinion on things, and the lucky thing for us is we've got the great investors to listen to and learn from as well. We can see the exact stocks that Warren Buffett buys each year, and his overall portfolio. Now, Ray Dalio, he's often on CNBC expressing his opinion on things, same with Charlie Munger, but the key is we have to listen to those that we know and trust. Do we have to listen to that pundit who's always braving about the latest hype on CNBC, or the new YouTuber getting a lot of views talking about owning Tesla stock? Do they understand investing? Do they understand the intrinsic value of each stock? So, only listen to those you know and trust. Step number 5, understand what you are investing in. This is a very simple rule, but one not too many people follow, and that is understanding the company you're investing in. If we take a look at Warren Buffett's portfolio, one thing that you'll notice is that a lot of companies that he owns are very simple. You've got the company Coca-Cola. They simply sell soft drinks, and they've expanded their business to food as well. Southwest Airlines, they are an airline that makes money by selling flight tickets. Furniture Mart, they sell furniture. Apple sells iPhones and other technology. Warren Buffett makes sure that before he buys a stock he is capable of understanding the company, and you should do the same. If you're into cars, look deeper, and so Ford, Toyota, Tesla. If you're into e-commerce, then Amazon and Alibaba. If you like the online world, look at companies like Alphabet, who own Google and YouTube. For pretty much every different passion or interest, there are stocks out there to be bought. Only buy those companies that you are capable of understanding. Step number 6. Be fearful when others are greedy and greedy when others are fearful. This is a rule that is particularly relevant to today's market conditions. The thing about these current market conditions is, we've had a bull market for about 11 years now, and stocks have gone up over 300%. Everyone thinks that they are geniuses when it comes to the stock market because everything's been rising and everyone is making money. This leads to one obvious thing. Everyone becomes greedy because of their overconfidence and their investing skills. Now, what do you think this does to stock prices? Well, overinflate prices. Everyone wants to invest, so the stock prices go higher, making it harder and harder each day to find a deal in the stock market. These are times when we need to be fearful and careful with our investments, and this is exactly what Buffett is doing. He has $214 billion in publicly traded stocks and $128 billion in cash. That's a lot of money in cash. He's employing a very careful strategy in these market conditions. You could say he's been fearful. But you can bet your bottom dollar that as soon as panic starts to set in with the stock market, Warren Buffett's greed will kick in, and he will be snapping up a lot of stocks when they're on sale. Step number 7. Buy at a price below intrinsic value. If you do not follow this rule when it comes to investing, all of the other rules go out the window, and your investing strategy will be useless. No matter how good the company, how good managers are, how much you understand the company, it is not worth an infinite price. You must make sure that the price you are buying for is below or at intrinsic value. Let me just explain this a little more clearly. Let's say you're looking at buying a Lamborghini. There's no doubt in anyone's mind that this is a solid, amazing quality car. There's no doubt that the manufacturers took amazing care and precision when developing this car. But the one question you need to ask is it worth its price tag? Is it worth that $350,000? Remember, no car is worth an infinite price, and it's the same with business and stocks. This is why Warren Buffett says, no company, no matter how wonderful, is worth an infinite price. Price is what you pay, value is what you get, and to know the value of each stock you first need to know the intrinsic value of the stock. I'd say these 7 rules are quite integral when it comes to investing. You need the correct mindset of knowing that in stock, there's a part of a business, and if their business does well, you'll do well. Most news from those financial TV programs and most YouTubers is noise, not news. When you buy a stock, the best holding period is forever. Never buy a company you can't understand. Be fearful when others are greedy and greedy when others are fearful, and only buy a stock at a price that makes sense. Follow these 7 vital rules, and you will beat most investors. Hope you guys enjoyed our video. Make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a wonderful day.